LiteFinance, the world of financial freedom.
Hello, it's Monday, June 19th, and it is time to start the market forecast, in which we will of course summarize everything from macro data publications for this week to current fundamentals that are driving the markets, with the focus this time on gold. And so, let's start with the calendar, where after a busy week with the two most important central banks, namely Fed and ECB, that just raised their rates, we will have another, I think, interesting 5 days. So today nothing major is happening, and even on Tuesday the only thing is a Bank of Australia meeting minutes. Next, on Wednesday, we will get inflation data from the UK and the first of the 2-day Jerome Powell testimony in front of the Congress. So this will be, I think, the most important event. We will have to pay attention to how the Fed chief will be answering the questions, since it is one thing that we already received a monetary policy statement last week, but the testimony is something a bit different, where we might get something new out of it. On Thursday, we will get the Swiss National Bank rate decision, where we will get another 25 basis point increase. At least that is what the consensus of analysts says. Next, there will be a Bank of England's rate decision, where again, most likely 25 basis point increase. And as I mentioned, it will be the second day of the Jerome Powell testimony. On Friday, we will get PMI numbers from key economies from both sectors, manufacturing and services. So as you can see, this week's calendar is packed as well. So gold sees the future differently from other financial assets near its historical highs. The US stock indexes soared to the highest levels since 2022, hoping that the Fed's pause will turn into the end of the tightening, and the fall of treasury yields suggest a recession, but gold thinks differently. It assesses the chance of a hard and soft landing, and the XAU-USD's consolidation looks therefore appropriate. How will the most aggressively tightening cycle for decades end? No one knows the answer. The NZ, which is the New Zealand scenario, which is a classical one, could play out. The NZ, New Zealand Central Bank, was one of the first to have raised rates and provoked a recession. Or things may develop like in Australia and Canada, where economies turned out stable, allowing the RBA and BOC to resume raising rates after a pause. The US and German yield curve dynamics suggest a temporary recession. The advocates of hard landing say the Fed is clueless. So the central bank has forgotten about money supply, which is drastically decreasing. That means inflation will reduce too, and the economy will cool down fast. As a result, the USA will sink into a recession as early as Q1 2024. That scenario will be perfect for gold. Expectations of a decrease in GDP usually lead to a reduction in bond yields, lower the appeal of US assets, and put pressure on the US dollar. Still, if the reduction in money supply provokes an important inflation slowdown, gold won't win. So the Fed will likely want to keep rates high for a long time. As a result, real bond yields will grow while the XAU-USDs will go on sale. So the US economy is far from a recession despite the yield curve's signal. One can't expect a deep recession when the jobs market is so strong. A soft landing is likely to happen, which is bad news for gold. Its rally in November to May was driven by hopes for the Fed's dovish reversal, which will hardly occur before Q2 2024. And as a result, chances of the XAU-USD's uptrend will grow. So the situation worsens as the market plans to play against the Fed. 12 out of 18 FOMC members expected a Fed funds rate hike to 5.75%, and investors don't believe them. The Fed will likely make them believe, and the greenback will strengthen. Gold, the anti-dollar, will fall into disgrace. So it will be rational to sell gold on growth to 1,976, to 1,918 and 1,993 and 97 an ounce, or if it's unable to steady above 1,959. And so that will be all for today. Thank you guys for watching, and I'll see you in the next video.